Welcome to Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. And we believe wise investing starts with a plan. And your investments may have merit, relevance to a time and place, but this all depends on you, your objectives, and your goals. My name is Seth Krussman, and I'm here with Ben Brayshaw and John Ryder, and we're all planners and partners with Brayshaw Financial Group. Good morning, guys.
Good morning, Seth.
Good morning, Seth.
We're glad you're listening to Money on Tap. And if you're looking to sit down with an advisor and start making some of the right steps towards your financial goals, we welcome the opportunity to do that with you. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. You can also find us at Facebook at Money on Tap. On our show today, we are going to spend some time talking about the markets and how you can do a better job as an investor dealing with the up and down markets. Now, you're likely to face both of these in your lifetime, so what's the difference? How do we react in either one of these market experiences?
Seth, what I see, these last several years, we've been seeing the markets just kind of go up in a pretty nice fashion. I wouldn't say crazy up, but they're pretty steady. You know, we used to have a lot of volatility in the markets. It's been fairly steady, so we're not seeing quite as much volatility as we've seen in the past. However, I would caution you to when looking forward to expect to see some of that volatility coming back again. The issues that worry investors today, they're not necessarily new worries. We find that it's really important for people to stay focused, despite all the day-to-day distractions that we face, especially during periods of economic uncertainty. When the going gets tough, a lot of people head for the sidelines. They're kind of scared. That's not always a good thing. And so what we encourage people to do is to stay steady with what they're doing, not necessarily to be reactive to what's going on in the market and to be moving in and out, but to really have a game plan when it comes to that volatility. You know, the game plan may be very simple right now as you're seeing the markets go up and you see that. And you might like that, and we all do, as we look at our statements as they come in on a quarterly basis or a monthly basis, what have you. But the fact is we are destined to see more volatility coming in the future.
Yeah, I mean, when it actually kind of hurts me to say this, but John, I think you're right.
Ben, once in a while, once a year, I like hearing that from you.
Yeah. So, I think when people come into our office and we're talking to them, they don't want to sell anything that they own because they want to recover, right?
Mm-hmm. Oh, yes.
Somebody convince them to own X, Y, and Z, and they want to recover.
Not an official stock, by the way. X,
Yeah.
Y, and Z. Not an official one, right?
And so they're like, well, I don't want to wait for that to come back and so forth. And then when they talk about retirement, they're like, well, man, I don't know. The market ever perform? Like, they get nervous that they're not going to see performance in the market. And these woes that we see in these historical perspectives of what's happening is fairly concerning. I mean, that's one of the things that, I think people deal with on a daily basis.
Sure.
So it's easy to have a plan that everything's going to go up, right?
Oh, I like that.
I mean,
I like that.
That's
steady, 12% growth per year.
That's kind of I think a lot of the investor mindset, and I've fall into all of the same traps. I think we're all human beings, and when we go through experiences, when we go through challenges, it's I've had coaches tell me, I've had multiple people that have been mentors in my life through challenges that have talked to me about it's how we react when things aren't going our way. And we're going to do a little bit of history, and that's going to draw on at least one of my minors. And we're going to look back at some of what the bear markets for the last few decades have held for us. But to do that, we're going to talk a little bit about what the bear market actually is and what a bull market actually is, just to identify the terms a bit. So
we've always heard the bulls and the bears and all that kind of thing. In fact, we talked not too long ago about the bull and the bear on Wall Street, those actual images that are there.
But we haven't talked about the bulls and the bears of Chicago.
That's right. For those of you in our Chicago audience, and I know we have some folks listening in Chicago. I know I was checking out the podcast.
Well, we talked about the Patriots a lot this year, and we might talk about the Celtics this year.
Well, we warned you if we have another game like we had the other night. Let me
Oh
tell
my
you.
gosh, can you believe that? I just can't believe how many people in Europe have listened to us. That's
Yeah,
crazy,
yeah,
Seth. Remember we were talking about that?
Yeah. It is. It's surprising. Like the Philippines and the international chatter out there is kind of an
amazing.
interesting piece. It is. It's not what we'd expect.
You know, and just to bring everyone into a global perspective, since we just mentioned that, it's interesting. We're working on a presentation for something, and we've talked on the show a lot about demographics,
Sure.
And the aging population of America. But I have a chart here that I had was showing John the other day. Seth, I don't think you've seen it yet.
No, and I love charts. I don't know why you haven't. Why are you holding back charts from me?
I am holding this chart back from you. It's a surprise. So right now, so it just was interesting how on a global level the demographic shift in population change.
Yeah.
It's not just the U.S. and it just the and I knew that generally, but I hadn't seen anything as dramatic as literally the underage 5 population declining since 1950, expected to decline like below half of what it was in 1950.
No one's having kids anymore. They're
percentage-wise.
having 1.2, right?
Yeah, so under 5. Yeah, so
Unlike your 12 children, Ben.
I know, 12.
Yeah.
I hope not. but anyways, the people over 65 on a global level are continuing to rise, which, from a perspective of how we invest and understanding the income and the retirement concerns, that's definitely something that we, we're probably going to take a different perspective on with some of the international listeners we have, which is kind of neat. So.
Yeah, and there's part of the planning and part of the reality is that we're in a global market anymore, and it's not just U.S. market, U.S. trading. There's so much more going on out there. But I can't help myself. What is the deal with the Bulls and the Bears? Like, is there? And I'd love to have a listener give us a little bit of a history lesson and tell us, is there a tie to the Chicago markets?
I don't think
with
there
the
is.
Bulls and the Bears, because isn't that funny that Chicago
That's true.
would have the Bulls and the Bears?
And it's a big financial,
I think
Yeah,
they
big
stole
share,
it from New
big
York.
trading.
Is that what we're saying?
possibly.
Who knows?
Yeah, I don't know, but it just
I don't know.
seems-
It's all about the Celtics anyways.
Okay, all right. Well, so bear markets is basically a condition in which the securities and prices fall in a wide spread pessimism. Now, this causes the stock market's downward spiral to be self-sustaining. So figures can vary. Okay, so a downturn of 20% or more in a multiple broad market index like the Dow Jones or the S&P. So over the 2-month period, it's considered, if it turns down 20% over a 2-month period, it's considered an entry into a bear market.
Hi, my name is Ben Brayshaw, one of the co-hosts of Money on Tap. If you have questions when it comes to your retirement and are looking for a personalized solution, contact us at Brayshaw Financial Group. In today's volatile stock market, we can help you plan to find your successful retirement solution. Am I saving enough? Am I saving into the right places? Do my investments match my appetite for risk? Do I have a tax strategy that is going to help me keep more of what I earn? How can I maximize my Social Security income? If you are like most people, you are getting closer and closer to your retirement and may be wondering if you're taking the right steps. If you're in retirement, you may be wondering, am I maximizing my income while preserving my estate and caring for my family? We talk about all things financial in what we call three-dimensional investing, putting a plan around your financial future. If you feel that now is the time to start getting the answers to some of these questions for your own situation, give us a call at Brayshaw Financial Group at 855-226-8551. Headquartered in Bedford, New Hampshire, we have offices throughout New England and across the country. We would love the opportunity to show you how we can help. There's absolutely no cost or obligation just to meet with us, and we welcome you to our office. Call us at 855-226-8551.
Yeah, and we know what that feels like. I mean, we've all, I think, well, I don't know about all the listeners, but I know all of us here sitting behind the mics here have all experienced a bear market before, and it can be sometimes overwhelming. But, we've also experienced the other side where we've seen a bull market. So in contrast to a bear market, it's a bull market, and that's where we see the actual opposite thing happen. So take, for instance, right now, as most people remember, the S&P plunged in 2008. That's how a lot of people remember a bear. And then it bottomed out in March of 2009. So from there, we had stocks rebound, and they continued to increase for the next 8 years, and we're still experiencing this upward momentum without a huge 20% drop over a 2-month period. So during the current bull market, unemployment has actually fallen from 8.7% to 4.9%, which is huge. In real gross domestic production has grown from 14.5 trillion to 16.4 trillion as well. So what we really want to do is we want to just, as we're talking about, go down memory lane a little bit here with taking a look at some of the different markets and the market times there. So Ben, maybe you can kind of highlight some of the ones that we've seen in the past, and we're going to talk just a little bit about kind of some of the returns of what happened during those time frames.
Well, yeah, happy to, John. Happy to. You know, one of the things in talking about your unemployment statistic, the 8.7% down to 4.9, I think one thing that is, and I really not the expert to comment on this entirely, but I would say I'd really like to know how much the decline of the 8.7 down to 4.9% is the impact of retirees.
As people are coming off of the job market
Right.
and going into retirement.
Yeah, because, I mean, 10,000 people every day plus
yeah.
are retiring every day.
Over the next 2 decades, that's going to happen.
Right. So if you actually, I'm just curious how much of that percentage points is in relation to that, because once you've either been on unemployment, you know, and you fall off that side, or if you leave the job market based on their age perspectives, and you're not, you know, there's you know, that's going to reduce that number. So I'm just curious. I mean, I'd love to find out what that number is. So I'm just going to toss that out there. But yes, so bear markets. So in the past few decades, just going back into the 70s, in 73, 74, we had a bear market, right?
Yeah.
Then in 87, that was
John, you remember that, don't you?
I remember the 73 to 74 very well from my crib.
Ben and I don't, but
is it just that you have a bad memory or what? I don't know. Maybe you weren't around. Maybe you weren't around. But I remember those days. Dad coming home from work all angry. The market's down.
Gas lines.
Gas lines, yeah. Well, there were.
You remember that too?
I will say I can remember
the conversations
when Jimmy Carter was
Carter?
president. Yeah, Carter. Yes, I forgot the R.
Is that was he the president for Rhode Island too?
He was not from Rhode Island. No, Jimmy Carter was from Georgia, I believe, from Georgia. Yeah, but I do remember gas lines. I do remember long lines at the gas pumps. For sure. Okay, so fast forwarding from 73 to 74, then we went into 87.
So basically 13, 14 years later, right?
Yeah.
We had another bear market. Then fast forward another 13 years later again.
.com bubble in 2000.
2000. So, I mean, that's interesting. 2 13-year spans.
Yeah.
I think, you know, people are always looking for numbers, right?
Right.
And then we fast forward to, you know, 2007 to 2009.
So that's 5
so
years.
5 years.
And we all can remember that painful time. I know I do. There's a lot going on then. But, you know, it's interesting when we look at the actual numbers and see kind of what happened, because I think sometimes history, you know, we always talk about how history is going to repeat itself, or it does repeat itself.
Yeah.
There's some truth in that. And so there's a piece that I pulled from Legg Mason. It's an investment manager out there. And they just did a really good job of putting a piece together that talked about kind of the cumulative total returns of the S&P 500. This is not necessarily of a particular fund, but it actually has to do with an index. You know, the top 500 stocks in the United States, domestically speaking. And when you take a look at those different segments, so from 1973 to 1974, the 1987 bear market, 2000 to 2002 bear market, the 2007 to 2009 bear market, it shows really some interesting things. And I wish I could show all of the listeners here the bar chart that we are looking at. But it shows that there's a gray bar, and that gray bar is a negative number for the 1973 to 1974 bear market. It's a negative 48.20%.
So that's the peak to trough is what we call that.
Yeah, so we call, or there, you know, people might call it the high to the low. So the high to the low went down 48%. So very interestingly, okay, Seth,
so 50. Let's just 50%.
Okay, so down 50%.
50%.
1 year after the end of this bear market, the markets were up 25, call it 26%. That was 1 year after. Now, 5 years after, it was up 75%, 74.66. But then if you looked at a full 10 years after the end of that market, it was up 267%. So pretty powerful. But you know what? Here's what I tell investors. When you're in the trenches and you're feeling that down, you have no idea what's coming next. But that's why it is good to remind people of history and what happens later on, typically, after we have big market turns. And you know what? We're not even in a position right now where we are here in 2017 where we're seeing big market dives at all. But the fact is I fully expect for us to see those in the future. And I think having a very good perspective of history and how markets have returned really helps people to understand much better their situation when they're in the moment. And maybe, Seth, you want to go into the 1987 bear market and talk a little bit about that.
You know what I was going to do here. Actually, I was give me just a second on the math here because I think it is interesting. So, on average, of these 4 bear markets that we've kind of got highlighted here, and we've got some data around, if we were to take the cumulative or the average of that peak to trough or the high to low, it's 46%. So that's over those bear market cycles each time. I mean, if we were to just take an average, if we were to have some kind of an expectation around what a bear market might look like, it's probably going to be roughly 40 to 50% of a free fall. Basically.
That is a great point. And think about this. Think about this. If you have your $100,000 portfolio, and over that time the market's dropped 50%, what do you have at the end of that time? $50,000. So it's amazing, really, how much it can decimate a portfolio.
Well, I think the reason these bear markets are so scary for the retiree, and just to lay it straight out there, why this is so relevant, right? If you were to retire just after a bear market, your likelihood of having a successful retirement on a constant climbing value is significantly better than if you were, to retire right before a bear market.
So timing can be everything sometimes. We often talk about not doing market timing, and we're not talking about that specifically, but as far as timing of retirement, you don't really know what's going to be happening in the market when you retire in maybe 5 or 10 years or 12 years.
Well, and how many times do we have the conversation with friends, relatives, even people that aren't clients that talk about retirement, and the statement I hear recurring will be, well, if the market continues to do what it's done, or if it just even holds out, I'm looking to retire in 1 year, 2 years, something along those lines, right? They've kind of got this timeline and a dollar amount that usually is associated with, I need that much money to make a retirement happen.
Yeah, and I think if we were to look at retirement as 20-year blocks of time, right? So you retire at, say, 66, and life expectancy is 85 to 87, right, men and women. And that 20-year block, it's like if you retire on a down cycle 20-year block, your retirement is horrendous. And if you retire on an up cycle 20-year block, retirement's great. And the thing that
I want to retire on the up one.
Right. I think that's the thing that people are, these big companies that give you all these averages and what they can do, this, that, and the other thing, I mean, they're all looking at those averages. Yeah, it will work out. So when you're younger, and especially for like the millennial generation, when you're younger, you have the ability to still ride, 20, 40, maybe 60 years on some
market
investments.
Growth,
with market growth and ride these bears. And that completely makes sense. But when you actually have to make the decision for retirement, you have one chance to make it successful. That's the fear that everyone does not really know how to communicate across the table when they sit down with a financial planner. And I think when you're sitting with a financial planner and they're communicating, we understand you have one chance to make this successful, and let's figure out how we're going to make that happen. That's the conversation you need to have. And it doesn't necessarily mean the stock market, right? I mean, there's all sorts of types of investments that we have that can either be correlated to the market or they are the market, but it doesn't mean that all your money goes in one place either. So I think when you look at these bear markets, it's really scary, Seth, as you pointed out. That 46% negative drawdown, that's horrendous. I mean, that's half of your income gone if you're taking a standard straight distribution on it.
Yeah, so if you've got a dollar amount of like $1 million, that's your target, and you know that $1 million gets you, $50,000 of retirement income. Add your Social Security in there, whatever else your other income is, and if you're looking to retire, and basically that $50,000 goes down to $25,000 if you have a bear market cycle happen immediately out of the gate. So that's what we're talking about: is how do you go into retirement? You still have needs, you still have bills, you still have medical insurance that you're going to have to be covering. So how do you now live your life from a $50,000 income to half? How do you strip away half of your income? Because that's the challenge that anybody has to face is I'm either going to have to live on half, or I'm going to have to continue to draw down off of my retirement. And I mean, that then can be catastrophic. If you can modify your life, you maybe have better chance of surviving. But if you can't, you're looking at you're going to run out of money is ultimately what the other result is. So you are listening to Money on Tap. And we're glad you're listening today. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. You can also find us at Facebook at Money on Tap. We appreciate all of our listeners out there and all of you that have followed us on Facebook or SoundCloud or your Apple podcast, and all of the likes and the downloads and the comments and the feedback. We really appreciate engaging with our audience, and it's kind of one of the things that's kind of funny about doing, a radio or a podcast show, is we're having a great time here with each other talking about topics, but sometimes we don't get the opportunity to be in your living room like we would, or you in our office like we normally would, to have these conversations with you. So you getting back in touch with us and letting us know you had a question on one of our topics, or you have a topic that you'd like us to address, is what we enjoy, I think, most about doing what we're doing here today. And hopefully it's educational, hopefully it's inspiring, and those are a couple of our goals that we've set out with our clients, and kind of for the outline of our show is to hopefully have an educational experience and something that you can at least take away from today and either apply or have some more questions that we can come back around and answer in a way that makes you feel empowered about your experience and having a successful experience through whatever your financial goals might be.
Absolutely. Well, Seth, wrapping up the history lesson that we're talking about here, through every bear market that we've seen in the last few decades, it's interesting to note that even when we see the assets or the returns really diminish and fall off and people losing 50%, it's amazing how always when you look at the time periods following those down markets, we see incredible returns. And that just is a great confidence builder. If you are in the middle of that down market, you see things going down, just be assured that you hang in there, and eventually the markets seem to typically to come back. At least that's what they've done in history. So what I'd like to do is spend just a little bit of time talking about what we need to be doing during those down times. First of all, Ben, Seth, we see a lot of people when the markets are down getting very emotional about their investment decisions. And sometimes
that always helps.
Yeah, well,
all of my decisions need have.
Well, it's interesting. A lot of the portfolios that we use, many times the strategies that are behind those are designed to remove emotion. For instance, if you take a look at different pension funds out there that are managed by large institutions, large money managers, they have different rules in place. So they're not getting all emotional about Apple stock, or they're not getting emotional about a presidency that is coming or going. What they are doing is they have a very rules-based strategy for buying in or buying out of the market. And it is not based upon emotion. Now, that's very, very different from the average investor out there. The average investor, quite frankly, is moving money in and out based upon what they're reading in the newspaper, what they're seeing in Bloomberg, whatever it may be. And so they're very reactionary. And that many times can be a mistake. So please do not let emotions drive your decisions. And also something that we help folks quite a bit with here, number 2, is helping people to understand their risk tolerance. And Ben, I thought maybe I'd just have you go into that a little bit. You have had a lot of experience in dealing with clients and dealing with establishing risk tolerances and all. And I thought maybe that would be a good topic for you to go over.
Yeah, no, happy to. I think this is one area that I spend a lot of time on due to the kind of investment work that we do. Understanding risk is a really complicated thing. It's kind of like explaining to someone why their car is broken, You know, the person comes up at the register and says, you know, you've got XYZ part and the carburetor and you know, and then all these different things come out, and you recognize some of the words, but in reality, you have no idea how to verify whether you have a broken muffler pipe, carburetor, you know, like,
Right.
you know, there's no way.
All I hear is the bottom line number. It's going to cost you $1,575. Okay,
And
great.
at the end of the day, you don't know if they just drove your car in and drove it out, you know, right? So I think for people to understand risk, you know, they generally understand, like, hey, this is the car and this is what starts, and I've heard about these parts and this, that, and the other thing. But that's the extent of what people really understand about risk, though they think they know more.
Well, let me ask you a question, Ben. Why would you say that risk tolerance is so important? I mean, obviously different investments are important, but why is risk tolerance for an individual so important?
Well, I think besides the obvious, right, you're taking too much risk. I think the reason we spend so much time on risk is because people don't really understand how to quantify their risk. You know, a lot of them realized they were taking a lot more risk than they understood to be taking back in 2008. I will tell you that people were like, "Wow, I had no idea." You would hear them come in the office and be like, "I had no idea. Like, I could possibly lose this much money. I thought I was in these safe investments."
Yeah.
And at the end of the day, they're within the risk that it occurred, right? So, trying to educate people through that has been a process and really a driving force of our practice, in which we have on our main page of our website at brayshawfinancial.com a risk analysis tool that you can actually click on and stick your portfolio in and get an idea of what, you know, risk calculation your portfolio would fall into, along with taking a test on the same scaling to compare them. Now, there's no direct correlation specifically to this, that, the other thing. The only comparison tool it gives you is comparing your thoughts and your portfolio on the same scale.
Okay, so if I have a 401k out there, if I have an IRA with a brokerage firm, if I have some money at the bank, I can actually take those different assets and plug them into the Riskalyze software, and it's going to come back and tell me what, that I'm high risk or I'm low risk, or what's it going to tell me?
Well, it's going to give you some numbers. It's going to give you a number between, you know, 0 and 100, essentially. And
So if I'm 100, I am crazy risky, or I am
crazy risky,
okay,
John.
crazy risky.
Watch out.
Jumping out of planes.
John, you are that guy. You are that guy. So I think when you really break down this risk analysis tool that we have, it simply is the ability for you to show real disparities, high disparity. You know, so John, you'd be looking at like a, you know, if you had a 75 and a 25 or a 50 and an 80, you'd say to yourself, something's not quite right here. If my risk says I'm only a 50 on our scale and you've got stuff coming through at 80, you know, there should be a flag there for you to reevaluate.
So it's not matching up, in other words. Now, Seth, I know you've had a lot of experience using Riskalyze. Seth, tell me what happens when you see a couple come in and they have... Do you typically see people on the same side of things or on the different side of things when it comes to risk? What are you seeing?
As far as the couples go, they're almost always polar opposites.
They are. It's kind of like people. You marry an introvert, you're an extrovert.
Yeah.
It's just the same way with money.
Oh yeah. There's usually the gas and there's usually the brake, and that's, you know, one of the ways that as long as everybody communicates, it works out really well. You know, and one of the things that I know that the tool is really good at, I think, is just helping people kind of identify where they're at. Like, what does it really mean when you know, what does a 50 mean? What does a 75 mean? 25? What do these numbers really mean? And the technology really is an award-winning technology that allows people to kind of grasp, if I have, say, $100,000 or $1 million portfolio, and in the next 6 months I were to, you know, have, you know, I don't know, $125,000 or, you know, $75,000, you know, so you kind of get these questions thrown at you that have a pretty accurate response to how you would respond in certain different kinds of risk. And basically you would go up and you would go down, so that's volatility. So there's typically this relationship with the volatility and the risk, which they call risk-related returns, right? And that's where people will, a lot of the times in a much younger age, start to you know, accumulate portfolios in stocks. That's the highest risk that typically a portfolio is going to hold. and then a portion of that in bonds, which is typically associated with a lower risk. But what I think is really interesting sometimes is that it doesn't always, risk does not always equate to a return. And we've seen that quite oh gosh, what am I trying to? We have seen this over and over again, where we pull a portfolio and put it in, and we understand the risk associated with a portfolio, and we can start to see what the historical returns and get an understanding of what the future returns on that might be. And then we can, and let's say it's a risk of 75. That's a fairly high, moderate to high risk.
Sure.
And then we can actually find portfolios or put portfolios together that might have a risk of 35, so much less risk, and you would associate the return being much less too. And that's a very typical association around risk. But what we've been able to see is much higher returns in some of those areas that people just wouldn't think would work. It doesn't rationalize the way it should, or the way that all of our portfolio dynamics and theory would work.
Yeah, and that's the reason we've had this demographic shift is killing all of the statistics. I mean, that's really what's pushing these numbers to skew, because, and we tell this to people all the time. I really think you can get better returns taking less risk. I really do. Over the next 20 years, I think depending on how you structure your portfolio and so forth, and focusing on maybe where the baby boomers are going to spend that money that they've got, and how they're going to redistribute it inside their assets and so forth, investment wise. I think you can really take advantage of some opportunities if you're smart enough. But I think at the end of the day, that's why we're seeing these tools and looking at it saying, hey, you know what? You're taking all this risk and you're not making the returns. Because you're hoping that, hey, I'm going to take this big risk, and I'm looking at these these 4 bear markets, right, that you have outlined here, John, that you've look at this. It's like after 10 years, right? So in 73, after 10 years later, the market's up 267%. In 87, after the bear market of being down, peak to trough of 33.5%, it's up 456%.
That's great looking on paper, but when you're down in that valley and your money's going down and down and down and down, you get your next statement that says down another 10% and down another 50%. You don't feel that way, and you think it will never come back. That's kind of how you feel.
But here's my point. Okay, so in 2000, 2002, right, we have we're down 50% almost, but the recovery is only 120%. Right? They can't report recovery yet because they haven't actually evaluated it on this one. Okay, but when you really think about what's happening, and I'm just looking at the age spans of that baby boomers flying through, why isn't the recovery so much better? Like on those big, deep dips. Is it because people are moving to different allocations, taking less risk? I think that's, because the baby boomers, what was it, 2010? I think the baby boomers officially started. Something, in that time period. And so it's like, hey, where's that money all going? Because when you were a baby boomer and you're starting to retire, I mean, because there's the accumulation phase and the distribution phase, but it's not a light switch. You don't instantly move into there, though a lot of people treat it that way. You should be reallocating long before staging your money into the preparation of retirement.
Well, let's go into that. So we've talked about a couple different things. One, don't let emotion drive your decisions. 2, understand your risk tolerance. Really important. You can do that by going to BrayshawFinancial.com and use the Riskalyze software, which is really, really powerful. But on top of that, what I think is extremely important, and we hear this all the time, and people know this, people that don't know anything about investing will tell me this. Be diversified. Think about this. I'm going to make this very, very simple. If you just have 2 stocks in your portfolio, let's say that you own Apple and you own Coca-Cola. Let's say that one goes through the roof and one goes down the toilet. The thing is, what's going to happen there is that shows you what happens with diversification. And if you only have 2 stocks in your portfolio, they go up and down. They can level each other off. However, it would be much wiser to have much more pieces of the pie in order to make sure that when things go down for one of your portfolios, it's not going to be as big a deal. And that's really what we preach with people, is making sure that you have a good, diverse portfolio.
And taking gains. People are like, oh, it's still going up, though. It's still going up. It's still going up. So, it's in the toilet. What do we do? I'm not going to sell it now.
So something that you reminded me about was my grandfather. I never met my grandfather. Died before I was born. My dad would my grandfather did phenomenally well in perspective from where he came from, Great Depression, and worked for John Deere for years and years, became regional. But one of the things that he did, one of the ways that he would trade was called a cyclical trade. And you could even take a look at the charts that we look at here and say, well, why don't we just do a cyclical trade? And what that means is with the Deere stock, it was associated with agriculture. And this is the way it used to be before it kind of got into much more global agriculture that would rise and fall based off of the seasons. So what Grandpa Krussman would do, he would buy at the low and he would ride it up. And every year, it was like clockwork. It was his little trading system that he had. It didn't matter how high it got and whether or not he thought it might go higher. He would sell it and take those gains and walk away until the next year when it would go back down, and then he would buy it. And he was just very mechanical about that buy and sell on that John Deere stock that he owned. And he worked for the company, and he had probably way too much money in the company if we were to take a look at a diversification model today. But that was his strategy of doing that. And if I were to take a look at the markets, people might ask us that. Oh, well, if I were to buy at the low. Sorry about the sarcasm, guys. I know you love it when I do my little thing over here.
We're all sarcastic. Yeah, that's rough. That's rough. Can't we have one nice person on this radio show?
If I were to buy at the low,
I'm here, John. I'm right here.
Then I would have.
Can't we have one? Can't we have one?
So then I would have a 456 percent return off of a market cycle. Let's just call market cycle and buy low, sell high, but. That just doesn't happen that way, does it? How many people do we know that come into the office and say, sitting down with us and just, what, I have bought the low and sold the high every single time.
Yeah, I mean, that's the thing. People are always looking for every penny they can get. And I don't blame them. I don't blame them. But at the end of the day, if you don't take gains, like the concept of rebalancing is the methodology of taking gains.
Right, because if you don't rebalance, you get too heavy in one security, right?
Right, and so when people are like, oh, well, this one's up and I shouldn't sell that one, it's like, no, that's when you sell.
But that's where we talk about the old greed versus fear. Isn't that what drives the markets?
Yeah.
People want to hold on to it, but they don't want to let go.
Yeah,
because they want eke as much return, but to be able to time that impeccably is just impossible.
No, it's a great point. It's a great point. So just to jump into one last piece here, John. On this.
Wait! I gotta interrupt you for just a second and let people know that they're listening to Money on Tap. That's Ben Brayshaw and John Ryder there. I'm Seth Krussman. We're glad you're listening today, and you can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And that's all. Thanks, Ben. Appreciate it.
So, John Ryder, after I said all that I just said, the next point to this article is stay invested.
Yeah, it's kind of almost contrary, right?
Contrary to what we just
fully invested.
No, but this is a common piece of knowledge that's in our industry that we talk about on a fairly regular basis, which is, if you stay fully invested, right? And they're saying they're talking about the S&P index from January 2nd, 1997 to December 30th, 2016. If you stayed fully invested, you would have averaged 5.88%.
Wow, I think it would be more, wouldn't you?
You'd think.
Okay.
Because they included those last couple of years of the 90s, which is, was a good time. So,
but I guess it includes all the bear market that we had too in there too. So
if you missed the top 10 days,
meaning if you pulled your money out for one reason or another,
for one day, for those top 10
for 10 days, okay,
your portfolio return would be about 60% lower, okay, at 2.15% average. Okay. If you miss the top 20 days, okay, now we're talking about almost, basically almost 20 years here of time, okay? If you missed just 20 of the days of those years, you would actually have a negative return. Negative 0.31%.
So out of about 7,000 days, you're talking about only missing 20 days, and you're negative.
Yeah, exactly.
Jeez.
So
bad job, Seth, pulling the money out of the market then when you did that. You should have just stayed invested,
you're
buddy.
talking about a percent of a percent
slept
of
in
days.
and taken a vacation on those days.
Yeah. Now, let's just jump down here 10 more days. missed the top 30 days of those almost 20 years, negative 2.43%.
Wow, that is stunning. And then you even go further on down to the bottom of the chart there where it talks about if you miss 100 of the top days, you have a negative 13.33% rate of return if you're invested in the S&P 500 index. So that's really speaking to the point of staying invested and not jumping in and out when the market.
No, this report's based off of Morningstar. Okay, sure. And what's really interesting about this report, and when you think about 2008, right? People who jumped out at different times and stayed out and said, well, I'm going to wait till the recovery starts. Those recovery days in the initial... Those are big recovery days. Yeah. Those are some of those 10 or 20 days.
Yeah. And one thing I like to remind listeners as well, too, is that diversification doesn't necessarily assure a profit or protection against market loss, because you can certainly lose money, well diversified or not, and people certainly did. But just remember that any investment that you do, whether that be an S&P 500 a type of investment, a Dow Jones 30, a stock market investment, anything out there, those all have risk. And you can lose money when you invest in those types of securities. So just be advised of that, going forward.
Yeah, I love a Fidelity study that they went and did on what are their highest returning accounts, and they went and called the people that had these higher returning accounts, and they took a look at all the data, all the matrix, and they just found they went and called those people that had the highest returns and asked them, so what are you doing? What is your strategy? What has happened here? How are your returns so much better than everybody else's? And the predominant response was, I didn't even realize I had an account with you.
I forgot I had the money. Yeah,
Forget it. Forget about it.
Yeah, it's easy for me to forget the $150,000. Oh, I didn't even know I had it. Thank you for bringing that to my attention. Thank you. Yeah. So that is fascinating, though. Can you imagine?
Hilarious.
Yeah.
I can't even tell you. We all the different times that we do. When we're gathering data for people all the time, it's like we give them basically a real simple PDF document, right, John?
Yeah,
Seth?
4 or 5 page deal.
Yeah, it's just, and they're like, wow, there's a lot of information on this thing, and I don't know if I have a lot of this stuff, and I'm like, well, listen, it's really meant to be more of a checklist, so fill it out. It's not meant to be laborsome. It's meant to ask you to ask the right questions of yourself, and I can't tell you how many times people fill that thing out, and they come back and they're like, I forgot about this account, or even when we go through it, and they're like, I know I've got an old retirement account somewhere. I have no idea where it is.
Yeah. Oh, I just had recently a lady do that. She had a pension. She wasn't even aware that she had the ability to roll over, and she's like, "Oh yeah, I guess we did have this extra $100,000. I didn't even remember that. I thought we had something there, but I wasn't quite sure." So,
I had a gentleman who worked at Boeing for a while, and I talked to him. I said, "Do you have any retirement from Boeing?" He's like, no, I don't think I do. I don't think I do. I was like, well, what about the pension from Boeing? Oh, yeah, I do have a pension from Boeing.
Yeah. They don't equate pension to investment.
That would be part of retirement.
Yeah.
So, it's just people are so busy in life and keeping track of that. So the other day, I had a client that passed away, and the wife was in the office with the daughter, and we were going through everything, and she said, hey, there's an account listed here that, said, I said, basically, it had XYZ company, and I just had the company as a listing there, and I put, not under BFG management, not under our management.
Sure.
And I put next to the holding, I put unknown.
Yeah.
And she goes, why do you have that? I said, well, at some point in time, your parents brought in a document that said that company's name on it. It didn't give any information, didn't have an account number, didn't have anything, but obviously something occurred with that company, an investment company. And I said, I put it on there just to kind of be a reminder so that if somebody stumbled across it, and the mom's like, yeah, I know we did something with them, but I can't remember. And, now the daughter, but I can't force people to go through it. No. But I try to write down as much as we can and collect as much data as we can so that we can actually give people clues, because the last thing you want to have to do is after you close an estate, reopen it. That's such a pain.
Well, you guys have all heard of the website like abandonedproperty.com or whatever, where you can check to see if you have assets. Actually, just recently had a client that discovered that they had some money they didn't even know about. It wasn't a whole lot, but they got somehow they got a mailing and they checked it out. And actually, no, their granddaughter brought it to their attention. Said, "Hey, you just ought to check this out, Grandma and Grandpa." And they checked it out and they saw they had a few $1,000s. Had no idea that they had it, but when they're
It's amazing how many parents bought life insurance policies on kids, for instance, that are just sitting out there. I have a
and
friend,
some cash value in those too. Yeah.
I have a friend of mine from high school that works with Genworth, and he does recovery. Discover on recovery.
Yes, yeah, you're telling me.
I was
about
telling you about it. Yeah, his job is to solely go out and find beneficiaries of policies.
Wouldn't that be fun? Or maybe, I don't know.
I think it'd be exciting.
They have to do it for only like $5 too, right? I mean, they have to do lots of research and everything.
Oh yeah, he's constantly researching stuff, and he was telling me like the different places he goes to find information. It's just crazy.
Yeah,
Hey, I'm sorry to interrupt you two, but
we're having such a good time, Seth.
Hey,
Just leave us alone. We're talking.
We're doing a radio show here. We're doing a show. I know you guys are having a great time over there talking about your friends from high school. Anyways, yeah. So you are listening to Money on Tap. And if you're looking to sit down with an advisor and start making some of the right steps towards your financial goals, we welcome the opportunity to do that with you. And you can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And we spent a lot of time talking about these bear markets and how different ways that maybe you can be prepared. And we really haven't gotten into some specifics about what it is that we do at Brayshaw Financial Group and how do we prepare our clients. I mean, obviously we've thought a lot about it. We've talked a lot about it. And some of the things that we do, just believe it or not, we don't have the ability to just go ahead and disclose, and because we're not filing all sorts of paperwork with, the SI. With the SEC, with the FINRA. Yeah. So, I mean, there's a lot of that kind of goes behind the scenes here with us. We have a lot of what we focus on is exactly this, is preparing for the next piece, the next part. And how do we do that? And, stay invested is one of them. But if I were to just say, okay, as a model for myself, if I were to just say, get into the S&P fund and stay invested, and well, maybe that's great if I'm 20, 30, but, heading towards retirement, that could be catastrophic. And I think we talked a little bit about that. So maybe there's some things that we have in our wheelhouse that we like to deploy, and maybe we can talk a little bit about that.
It's Seth. You make a really good point. Stay invested concept. Well done, Seth. Well done. So it is true. You do need to stay invested, right? So that's the dilemma, right? And the market, the bear market, and so forth. I think where we significantly are different is some of the tactical work we do and looking at the demographic studies and allocating in a place that potentially offers opportunity, where the S&P 500 and just riding the market per se and in some mirrored fund of that is, subjecting yourself to these bear markets directly in a way that, can deal with these 40, 50% losses. And not that you can't have that in any market-based investment, and I'm not excluding us from that, but and that's just as a disclosure item. But I think when you really put some thought around the fact that we have some changing scenarios, that's the first piece. That's number one, right, John? I mean, Seth, that's what makes people different, is how they look at the market, how they invest, and strategizing around that. The story needs to make sense. You should be able to sit on that side of the table. You should be able to say, I understand what you're saying, and it's more than just a carburetor in my car, and that's something I can tangibly walk away with and have some competency around. That's the first thing.
Planning retirement is just a lot of people don't think about it because, okay, I'm putting money into my 401k, I'm doing this, I'm doing that. I'll listen to a show here and there that tells me to put money into a Roth IRA. But planning a retirement is actually a pretty complex thing to do. Think about this. If you're planning a trip from New Hampshire to California, there are a lot of different ways to get there. There are some ways that are more efficient than others. Obviously, jumping in the car and winding the byways and highways and all that may certainly work, but it's not going to get you there in probably the most efficient way. But there's some different things that come in the way of retirement. There's different things that you may not even be aware of. You may be aware of, but you're not really focusing on them. There are different roadblocks that come up on that trip to California. It could be inflation. It could be taxes. It could be procrastination, saying, I just don't want to do this.
Could be a death or disability.
It could be a death or disability. Any of those type of roadblocks that come in the way. So really what our job is to do is to help put a game plan together for you so that you have a very solid idea of how you're going to get there, when you're going to get there, how long you can stay there.
And how you overcome those obstacles.
Sure.
And address those
You
things.
know, longevity is one of these. It's like a two-sided knife. Really, it's a great thing. Medicines are keeping people alive longer and longer and longer, which is terrific. However, it is meaning that people have to have their money. If they have a traditional 65 retirement, they're needing to keep their retirement, their money around, and that money is easy to go through. And if you don't have a solid plan of how you're going to execute those dollars and how you're going to spend those dollars, then you're certainly at the risk of running out of those dollars for most people.
But John, I want to die spending my last dollar.
And
There's that sarcasm.
we have. He's back. Ben is back with the sarcasm coming strong. But no, some people have said that, and we've had people say, "Well, the last breath I take will be the last bit of oxygen that I pay for."
We deal with the ultimate number of gambles in life, right? We deal with the health gambles, the life expectancy gambles, the market gambles. There's all these different pieces inside there, and at the end of the day, there's a lot of clients, John, that just throw up their hands and say, I need a solution that's just going to lock this thing in.
Yeah, there's a lot of people out there. I have a lot of people that will ask me, and I know you guys the same way, hey, what do you think about annuities? Do you think annuities make sense for me? And you know what? It depends upon who I'm talking to.
Yeah.
But in many cases, an annuity can make a lot of sense for a person, because it really provides them with a type of investment that they actually can't outlive the income from.
Yeah.
So it will give you a paycheck for as long as you live. It has that capability. Now,
Yes.
there's a lot of different types of annuities out there too. We have everything from fixed annuities, which give you kind of like a guaranteed fixed type of rate. You also have equity index annuities that are invested. Variable annuities invested in the market. There's all different types.
And they got
out
all
there.
sorts of stuff that they offer. But I think where we look at this thing a little differently, and probably not, because there's a lot of firms, right, John, that are just all in one way, all in the other way.
Yeah, you need an annuity, absolutely.
Right. Yeah, that's what everyone kind of has that mentality of. And I think what it really is it's kind of like they're trying to put a tourniquet around, a paper cut sometimes.
Sure.
And sometimes they're putting a tourniquet around,
I don't think I've heard that before. That's pretty good.
Yeah, I mean, but that's sometimes what people do, and they don't necessarily need something like that. And then there's other people who really do have, some sort of hemorrhaging event that they need some serious help. And I think when we talk about foundational elements and we talk about building that house, and if you're first time listening to us, we talk about, having a solid foundation. Sometimes annuities really can be a good fit for some people. Sometimes it's a CD at the bank. It's some sort of something. Annuity just means means guarantee to pay. So the insurance company is guaranteeing to pay something, some way, somehow. And if you find one that fits your needs, whether it's an income or a death scenario, that's something you're trying to fill, hey, boom, it's good. It's a nice fit.
And that's really the difference. You mentioned insurance company. Well, annuities, mutual funds are issued by investment companies, but annuities are issued by insurance companies. And so basically, effectively, what you're doing is you're shifting the risk from yourself running out of money. You're shifting that risk to the insurance company. We have insurance in place for many different aspects of our lives, many different aspects of our lives, from property casualty to our automobiles to maybe if you're a surgeon, you insure your hands that you're able to operate. So there's many different things that you insure out there, but many people don't think about the aspect of insuring their investments. And so an annuity for a portion of your money can make good sense. Now, we'd never go out and say, well, you need to put 100% of your money here or 75% of your money. That wouldn't make sense. But there's certainly different applications for an annuity that can make sense for folks in the listening audience.
And we've come across a lot of those people. And Seth, you and I've sat down with a bunch of people too, and it's like they just want some level of understanding of taking some of this bear market fear out of their life. And when they can look towards something like a CD or an annuity or some sort of something providing some substance of, there's no guarantees in life, right? But some substance of, a surety or whatever, they look towards these institutions. And that's not necessarily a bad thing. And I think, when we talk about the market so much, it's not something that we're entirely embracing in every way.
And is there cost involved? Well, certainly there's more cost involved. If you're going to have guarantees that are in place, there certainly are costs that are involved in that. And you certainly want to evaluate those and make sure that you're making wise decisions based upon your dollars.
Well said, you guys. You have been listening to Money on Tap, and you can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. We also appreciate all our podcast listeners out there, and you guys have been a lot of fun. Have a great week.
Go Celtics.
Doubles.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.